Welcome to the Fund Selectors podcast with me, your host, Lucy Walker. I am a huge supporter of the voice of the fund buyer, and this podcast delves deep into the minds of the biggest and best in our industry. Today, I'm delighted to be joined by Hannah Evans, Head of Manager Research at Omnis Investments. Hannah is responsible for leading on the research for over £11 billion of assets invested all in third-party funds. And Omnis is linked with the Open Work Partnership, which has over 4,000 financial advisors. Hannah has a long career, 20 years in fact, ranging from institutional firms such as Russell Investments through to Omnis, which she joined 2 years ago. And unexpectedly, this episode pretty much entirely focuses on idea generation, because we started digging into a recent search which Hannah and her team undertook. I found it absolutely fascinating and continued delving further into the minutiae of her search and what she had to do and the things that the team did, and it was really, I thought, insightful, and I hope that you find it as useful as I did. There were two particular things I thought were interesting takeaways. One, for fund researchers, Hannah makes the very, very important point that no manager search is the same, and you have to be adaptable to the circumstances to be able to search accordingly depending on the sector, etc. And for asset managers, she made the very, very pertinent recommendation that managers should be honest. I hope you enjoy the episode. As ever, please tell me who you'd like on next and what you thought. See you next time. Hi, Hannah. Welcome to the Fund Selectors podcast.
Hi, Lucy. It's great to be here with you today. I'm so glad we've managed to get a time together to make this happen.
Me too. Yes, we've worked to put this in the diary, and I'm really glad that we have. I'm looking forward to the conversation. Great. So let's dive straight in. I know that you've had a background in institutional, but would love to hear kind of how you got into fund research, and obviously now in your current role in the investment arm of a financial planning company. So can you give us a sense of how you ended up in fund research?
Yeah, of course. So I didn't grow up thinking I was going to be a fund researcher. In fact, I don't think I even knew a fund researcher was a job that existed as I was growing up. I studied maths at university, and at the time when you went to think about careers, it was pretty much, do you want to be a maths teacher, an accountant, an actuary, or you could maybe do a master's in engineering and go somewhere with that. So at the time, I'm not exactly sure why, but I decided that I would like to pursue an actuarial career, which I did. So I fell into a pensions actuary world, um, which was enjoyable, but at the same time, there was another arm to the business I was in, which was the investment team. And I kept thinking the colleagues in the investment team seem to be doing a lot more interesting things than I am, if you can believe that, with pensions. And eventually, I switched teams and I went up to the investment team. And in an actuarial firm, part of the investment team is manager research. And I fell into that, and that's when I discovered what manager research was and realized that actually this is what I wanted to do and this was where I wanted to be. And the rest, as they sort of say from there, is history. And I moved on to take on full-time manager research roles at the various places I've worked.
Amazing. And what was it about manager research that kind of compelled you to take that as your future career?
So I think the way I describe manager research is I get to meet and interact with some really intelligent, super bright people on a regular basis. I get to engage with individuals who possess exceptional knowledge and expertise. Um, and it's really, really inspiring. And it's really humbling as well, because I'm always amazed at the access being a fund manager researcher gives you to meet some of these people with such ease. And not only do you get to meet them, you get to spend significant amounts of time with them, understanding what they're thinking, exchanging ideas, looking at their perspectives. And this can be from, a stock specific idea to a process to global economics to geopolitics. It's a real privilege to be able to to meet some of these people, spend time with them, and understand what they're thinking.
I think that answer will resonate with many listeners in fund research. Certainly it does with me. I completely agree. I always remember, I can't remember if I've said this on the podcast before, but my first ever manager meeting was with Ben Whitmore when I was at HSBC, and it was just so, it was sort of a eye-opening moment of, we get to, as you say, just spend time with these people that dedicate their, their lives, or certainly their professional lives, to deepening their knowledge and understanding of particular areas. So yeah, that completely resonates. Nice. So you then obviously went through a journey of institutional fund research, or manager research, I suppose would be the more accurate term. And then you've ended up at your current firm, Omnis. Would
Yep.
love to understand, with the experience that you've had, which I'm guessing was quite in depth and thorough from a kind of an institutional perspective. Can you talk us through when you're monitoring your list at Omnis? So to sort of set the scene for those that don't know Omnis, you're basically researching managers that you then actually give funds to, right, to manage. So it's a bit
Yep.
different to, for example, when I used to work in the industry, I would, find managers and I would invest in their fund. You're basically giving mandates to, which, and I believe
Yes.
some are single strategy and some are
Yes.
multi
Yeah.
manager.
Correct.
So
Yeah.
it would be really interesting to have a sense of that, because you must have a much longer term. Obviously lots of people have a long-term time horizon, but I feel like you must have to have a significantly longer time horizon when you're actually setting up a fund and then giving them the reins, as it were. So yeah, can you give us a sense of how how your thinking has evolved on that front, and how you go about monitoring your managers?
Yeah. No, of course. So something that is definitely different between the institutional and working at Omnis is exactly what you're saying, something about these funds. And there are two parts when I have to think about this. There's the manager I'm going to select, and there is a fund. And we often talk about this, in fact, at board meetings and committees, because you need to make a decision that is the best for the fund and not the best for a manager. So there might be, some risk metrics that you want to put in, but that's for the overall fund, and that's for, in effect, perpetuity. That should be. And then but that might not exactly, because obviously each manager is different. That might not be the perfect parameters for the manager that you're selecting. And so you may monitor the manager on some parameters that you have selected, but that's different to what the fund needs to be monitored on. And I think it sounds quite simple, but it's very easy to miss the point, and it is quite different when you're monitoring the fund versus monitoring the manager. And I think that is something that you do need to get your head around when you move from the institutional to the way that we are investing at Omnis.
Interesting. Yeah, that's a dynamic I didn't have to deal with in that respect. So talk to me about, maybe let's start with idea generation. So when you're thinking about, fund managers that you might like to give a mandate to, I'm guessing the turnover within, as per our previous comment, the turnover within the fund, I'm guessing, is pretty low. Like, how many strategies do you have within your funds approximately? And of those, how many might change on, say, a yearly basis?
So there are 22, I guess, managers in the way I would count them, that I look at. And there is absolutely no normal in what would happen in 1 year. Like, it's just, so this year, potentially two, last year, none. Does that mean it's one a year? Absolutely not. You cannot control or know when a manager change is going to happen. And it can be for any reason. A manager could leave. It could be that the objectives when you set up that fund have completely changed, and the needs of the fund have completely changed. It could be that you think the manager that you put in has deteriorated or not, is unable now to meet the objectives that you wanted that manager to meet. There are so many reasons why you might change a manager that unfortunately there's no normal. And if there was, it'd make my life a lot easier. I'd say, right, we'll just have one every 6 months, because then I can very comfortably stagger my workload in a very consistent and nice way. And even if I was to say, okay, maybe it's 2 a year is maybe average, which I think would probably be a bit high, I can assure you they'd be both in the same month that it would need to happen, because there are just so many reasons, and you just can't predict what the needs might be. And whenever we are trying to do that, because obviously we do try and manage workloads, we always then add to, and it might be that that's completely ridiculous. And then at other times you're like, oh my, this could be 3 or 4. So there's no average year, unfortunately. And then I think the other part of your question was about idea generation. So we've done a search recently, and I think you can have a plan about how your idea generation works, and you redo, as I'm sure most people, a process doc about how these things are gone about. But actually, I think it changes with every search I do, and it changes on 2 things. One is the strength of the universe, because if you go into a search and you quite quickly whittle down your numbers, then it's quite easy to say, right, we're going to RFP these, and we've got this list from here, or we're going to check on these metrics. But if you have a really, really strong universe and you struggling to get it down to under 100, you've got to change how you're looking at that, because you can't meet with 100 managers. You can't read 100 full RFPs. So for our idea generation, to bring it down to a short list, we've done a couple this year. We always start as broad as we can. Because I mean, why wouldn't you? I think so. I think when we did this, I think we came in with the initial long list at something like 321, which is huge. We then filter on some very simple criteria, so very simple red lines. So these were active funds we were looking to do. So we just want to make sure that we've got no passives or quasi passives in there. So that will be one of the first things we would quickly look at. We want to make sure that there's nothing, no long shorts, because we're only looking at long funds. So things that are quite black and white, quite easy to screen out. And on that basis, I think on this particular search where we came up with 321, I think that easily brought it down for us to about 200. We then went away and through the data gathering websites, I got the team to pull it together, and we looked at some more detailed metrics. So it took a bit of time. And then from that, we dropped down to 118. And at this point, I was thinking, how are we going to drop this further? Because there's certain data points I don't trust on some of the websites. It's not because I think the websites are wrong. It's just when you actually ask the managers themselves, quite often that these things can change. I mean, fees would be my absolute go-to on that one. But we decided on this case, because it was a strong list, is we actually went out to each of those 100 managers with what we called an RFP Lite, which was an Excel spreadsheet which we hard coded, so you couldn't fill in boxes that weren't allowed to be filled in. All the boxes had yes, no's, or just one number that are allowed to go in, and pulled together this quite strong spreadsheet, which eventually did allow us to take it down to 18. And at which point, for us, that's a long shortlist, but that's how we idea generated from 300 down to 18. But it was I think there are no shortcuts to be taken, and I think if you don't start as broad as you can, you're limiting your investment universe and therefore limiting your opportunity to make the best choices.
Super interesting. So let's just back up. So you went from over 300 to 200 by getting rid of passive and quasi-passive, and then
there's a whole list. There's about 22 reasons. I think we wrote papers for everything. So there will be we would have got this, because of the objectives that we had for this one. It wasn't there was no objective to be sustainable, and we didn't want to have a sustainable objective in the fund. So I think ESG, if it was a objective of the fund, because we just think it limits the universe and what we're looking for, I think that was possibly one of the criteria. Having said that, we do need firms to be signatories to UNPRI and meet the UK Stewardship Code. So if they weren't there, that would have come out. If there was anything very unique about any of these funds, so I'm trying to think, you might have had some very specific funds that didn't want to invest in certain sectors, or it was a asset class. They were saying they were not going to go into energy or something, anything like that. We wanted to make sure we were looking at funds that had the best opportunity to beat our objectives.
Yeah, okay, cool. And then can you give us a high level of what then, halved the universe again down from kind of circa 200 to circa 100? Kind of,
Oh
I think you
yeah,
was talking about that being more kind of data metric led.
that was much. Yeah, so that was things we started looking at, things like risk metrics, um, so tracking errors, volatility, um, just trying to really understand what the risk appetite of these funds were and how that sat with our risk appetite. Um, we didn't want anything that had too little risk. We didn't want anything that had too much risk for this particular search. We started looking at all the tenures of the team and if there'd been a very recent turnover. We don't have any hard lines. We don't need teams to have been in place for 3 or 5 years. I know some places like that, but I think you can allow for some exceptions there. But obviously, if there's been huge amounts of turnover and someone's just been in for 1 month or something, it is quite a red flag that if you're in the industry and you looked through it and you speak a bit more to people, you might be able to find out whether or not that's going to be something you're comfortable with quite quickly rather than pursuing something that isn't going to work out. We also, I think at this point in time, also looked at all the performance to better understand that and make sure that the past performance tallied to the individuals as well, because that can be quite difficult to understand sometimes. Process
Sorry,
changes.
just to check on that front. So as in if you were looking at performance, but actually the management team had only recently joined, so you would just
Yes.
make,
Yeah. So we flagged that as just not as it wasn't a red line, but it was just okay, we need to be aware that we're not looking at something that could potentially be misleading,
Mhm.
because I think there's lots of things in our industry that can be misleading,
Mhm.
if I'm totally honest. And then let me think, what else did we look at? So there are some things at this point we would find out what capacity was. So we needed to make sure there was enough capacity for us. We also would find out if anything was white labeled, because usually we don't need to go through white labeling because it's another fee level and usually we can
Yeah.
just get direct access to the manager. So some of those names would have been white labeled. Um, there would be
Can I
some.
ask sorry, just quickly, can I ask you what the average size is of a Omnis mandate for a manager? Again, there's probably no average, but if there was a kind of ballpark figure.
Size of assets.
Yeah, so if you give a manager
Yeah.
a mandate, what's the kind of ballpark figure for that?
So there is no, yeah, you're very right that there's a huge flex around that, but we've got about 11 billion and we've got 22. So, I mean, it's about 500
Circa
million or so.
500.
So
Yeah.
that I would say is a real,
Yeah,
but yeah, I would say,
ballpark figure, but
yeah,
yeah, okay, no,
yeah,
that's nice and easy maths for us. 11
yeah,
billion and 22
yeah.
managers.
But it's,
And sorry, I cut you off to ask you that question. So, well, although I guess actually perhaps we could come on to then, you've got from your 100 and whatever it was, and then you've had this idea to do your RFP light, which sounds
yeah,
like
mini
a
RP
really
like,
yeah, which sounds like a really good idea, and especially to hard code it to mean that you can then run your own analysis on it rather than it being kind of free text that you then have to spend loads of time looking at
yeah.
it. So is that something you'd done before? Was that created from scratch?
No,
What are some of the
so on
things
this
that you had on
particular
there?
search, and as I say, when I'm doing idea generation, I think it was really interesting because I couldn't believe that when we had like done all the quick checks from the data you can just quite easily get, I was actually quite surprised that we still had this many managers left. And I was sitting looking at it and I was thinking, how on earth? Like they're all passing, like they've all got capacity, there are no they all seem, on the very limited information we have, they all seem strong managers. And I thought about it and I was like, I wonder if we can pull something together. And I just sort of went away and had to think about what I could do. And it was honestly, it wasn't a long, it was one page. I think we asked for average tenure, all the PMs. It was all in a spreadsheet. We also asked for the stock count. I think we asked for turnover numbers. capacity, we double check that again, because that can be something that I think generally data that you can get on the internet is not always super reliable on.
Hmm.
Um, we also ask for the minimum number of stocks and the maximum number of stocks held over a period of time, because that can be quite telling. If it's quite different to the average, it makes you wonder, just leads to another question, I suppose, rather than giving you anything. We ask for cash weighting as well, because Omnis for our funds, we're quite keen for them to be fully invested. And if you've got quite a high cash rating, it just can, again, it wouldn't be a definitive, but it's a follow-up question like, how's your process generated? Again, we double checked if everything was long only, because those flags, I think, on the main data's sources can also be misleading. Turnover, tracking error, active share. Again, sort of just testing, making sure that we weren't looking at a passive, or we don't want anything that's going to be super volatile, because ultimately we want our performance to be smooth. And whilst we will accept that there will be times where there is underperformance, we want to try and make it a smooth ride for the end client. It was really interesting, and all the managers responded to it as well. I thought we'd have quite a few gaps, but I think it was
Hmm.
so easy to fill out. And as I say, there were lots of questions which the only thing you could do in the box is put yes or no,
Mm.
which I think really, really helped.
Nice. Yeah, definitely interesting approach. And so you've whittled it down to 18,
Yeah.
and at that point you then get the full
Yes.
RFPs.
The
It's a
heavy
much
lifting
longer,
comes in. Yeah.
yeah, and it's a longer list than you would normally have. Did you
It
say,
was.
or does, in my mind I've got kind of 10 as like a usual number in my mind, but what would be the sort of the, again, haha, the average, but
Yeah,
but
I would say 10 is even long from my experience. It usually would go down, I'd say 5 to 10.
so this
Um,
was much longer then.
oh, much longer. I'm trying to think. And when we did it, I did remember thinking, oh, this is gonna be really tough to get through it. So we as a team, we split it. So
Hmm.
we split the RFPs to read through, and and then we'd have a meeting after each person had read it to discuss it, because I wanted there to be consistency in the approach, but I knew that we couldn't all read every single RFP. Um, so we would have, each person had a certain number of RFPs to read, and then that week we'd come and discuss what we thought the outcome of that was.
Nice. That sounds like a good way to do it, because yeah, everyone has their own slightly nuanced way of interpreting things, and so yeah, I can see that that will really help
Yeah,
to, yeah. So how many managers post those RFPs did you then end up meeting?
four,
Wow. So that
four
was probably
managers.
quite a tough
Oh
exercise. So
yeah.
you met 18 times after 18 RFPs,
Oh, so
and
wait,
then
no.
I
So I think, to be fair, we probably met 6 times, because we probably each at least did one. So it would have been between, probably I'd say 4 times, because we'd each discuss one
Right, you'd
RFP.
each
Does
met
that make
one. Yeah,
sense?
yeah,
Yeah,
yeah. No, that actually makes
yeah,
far more sense than meeting
yeah,
18 times.
yeah, yeah,
So yeah, so you met, a handful of times to cover off all of those
yeah.
RFPs, and then presumably you then met again to think about, well, okay, we've done this. Were you kind of shortlisting as you went, or were you
We were
kind
trying
of
to, but it was a moving target. And the other thing we were able to do is, because we had a lot more, obviously at this point we've got full data in from these managers, is we could do a lot more correlation work.
Mhm.
So a lot more quant Excel spreadsheet work on our side. And that was really useful, because I mean, if anyone out there has a better way of doing this without having that information at our fingertips, for obviously, if any incumbents, we have that information, but for new potential managers, we don't have that information. So having that information was very useful for us to then do some proper analysis on them. Um, and that allowed us to really think about how best some of these would fit.
Cool. So I think I'm right in saying that you're single strategy more so than you are multi, you're not blending necessarily a value and a growth manager. Therefore, or not, certainly not, I think more
Yeah.
commonly, I think you're single. So therefore, I assume based off your comments around smoothness of returns, you're more focused on finding core managers, if I'm
Yeah.
able to call it that.
So
Would that be accurate?
yes and no. So I guess ultimately our end clients are buying our MPS. So very rarely will our clients buy our single fund product. So they're buying our MPS models at the end of the day. So I mean, you could call that blended of those 22 I spoke to earlier. So we do want the performance of the NPS models to be smooth. And whilst within our fund range, we are mindful of not having extreme risk and extreme volatility, we will have some products do have like quite strong style tilts. You mentioned earlier. Ben Whitmore, we've been invested with Ben for a long time. So, I mean, he clearly has a strong style tilt. So there will be managers within our fund range that have quite a strong style tilt. What we wouldn't want to have is an entire fund range with a strong style tilt.
Mm-hmm.
So there will be a tilt of some sort, because ultimately, even if you put together a whole fund range of core managers, you would probably, unless they were all completely passive, you're going to end up with some tilts at some
Yeah.
point, especially as the market fluctuates. But ultimately, what we're trying to do, and it goes back to what I said earlier, actually, is we have the fund objectives, and they're set up, and we are looking to put a manager in place that will meet those fund objectives. And most of the time, those fund objectives will say something along the lines of beat benchmark X over a rolling 5-year period. And provided that you don't have a strong philosophical disagreement with, a particular style of investing or a particular concentration approach, then actually there will be managers that will have tilts, which I guess are not core, that can meet that objective.
Yeah, that makes sense. I hadn't appreciated that. Yeah, your kind of building blocks. I mean, it's obvious now you say it, but that they obviously blend together, and so yeah, you can have
Yeah.
some kind of style tilts that come together. So I guess this is working at Omnis. I'm guessing this has been your first kind of foray into the world of NPS. So yeah,
Yes.
I guess I suppose I would imagine you're thinking more about, as you said earlier, kind of correlation, because previously, I guess, more in an institutional mindset, my assumption, perhaps naively, would be that you would be doing a search for a particular thing and you would deliver on that thing rather than necessarily the kind of the blended solution, or have I got that wrong?
I would, yeah, I don't want to say you got it wrong.
That's fine.
I would say,
It's learning for
in
me and
in
maybe
my,
some of the
yeah.
listeners.
So in my previous role, but it's difficult. So in my individual role in a little box, yes, I'm just ultimately now, in fact, and in when working as usual, I'm ultimately just looking for the best manager. Where now I'm looking at that for the fund, and before I was looking, I want the best managers on my UK equity buy list, and now I want the best UK equity managers in my UK equity fund that's going to meet the objectives. But both now and in my institutional past, there were multi-manager products that was what was sold. So Russell has multi-manager products and Omnis has an NPS. So it's
I guess my assumption was, though, that you were somewhat more shielded from that, which I might be
yes,
wrong,
I
but
would
my assumption would be
that would
that you in your
agree.
manager research role, the kind of the manager would have been somewhere else. Whereas I'm guessing in a firm like Omnis, with I think you've got sort of an investment team of around 8, is it?
Yeah,
You're probably much closer to
yes, I
that
think
than you
that's
are.
fair. But I think that's absolutely fair, but I wouldn't have, it's not in the institutional world, you won't ultimately, those multi-managers, those portfolio managers could only buy off your buy list.
Yeah,
So they've got a very vested interest that your buy list is um, diversified with each other. You haven't just got like 4 UK value managers on there, and they haven't got any growth managers they can buy into, for example. So,
yeah.
so yes, I was probably more shielded, but it wasn't to say there were Chinese walls and I wasn't involved in conversations. I think that would be disingenuous to the
No,
reality.
sure.
Yeah.
Sure. And also, as ever, like anytime you have a buy list, you want that to be a diversified buy list. I guess I'm just
Yeah.
more thinking that the keenness of your attention on correlation and stuff is
Yes.
probably accentuated, I would guess,
Yes,
at
absolutely.
Omnis. Yeah, yeah. Okay, interesting. And so you've got your 4 managers, and you've whittled them down from 18 based off the off this big
Yeah.
RFP process. What were the key things that led you to choose those 4, rather than the 14 that you didn't go for? I mean,
Yeah.
I know from having been in those shoes, it's marginal, right? Often what
Yeah,
kind of lets you choose one from another. But what would you say
it was a
was the
strong,
big differentiator?
Well, I'll be completely honest. We were very lucky on one of them because the manager rang us up and pulled out because they had a complete team implosion. So that helped. That was quite an easy one for us to knock back on.
So you went down
Um,
to 17 with ease, and then
with ease,
what?
yeah. And then the others, to be completely honest with you, it was a lot of hard work, and there's no shortcuts. It was doing all the work, and the reasons for each of them mm, were very unique. Some of them had team changes, and we just couldn't get the conviction in the outcomes being replicated in the future, even though we'd asked if there had been a team change for the previous track record. There are a couple of cases where we're just like, you know what? And ultimately, I believe that my job is having convictions in outcomes being replicated in the future. It's not, I can't tell you exactly what performance in the future is going to be, but I believe very strongly that in manager research, you need to have conviction to say, I believe the manager will perform in this way. And as long as the manager performs in that way, that's when you can maintain your conviction. And as soon as you can't have confidence in understanding that and what's going to be replicated in the future, whether that's good or bad performance in different market environments, that's when, for me personally, I just cannot stand by a manager anymore. So there are a few managers where we just couldn't gather that conviction that we needed. Um, there are a couple that when we looked more deeply into what they were doing, we couldn't get comfortable with the philosophy versus the resource and the way that was um, working. So I think a good example would be, um, I guess, if you say you are very, very thematic and you're using lots and lots of research and resource, that's fine. But then you need to have lots of research and resource to back that up. And if that doesn't quite align, it's not that we're saying we don't like the thematics, we don't like what your outcomes are, but we're saying you can't say that you're utilizing all this resource and then we go and look and actually their resource is all globally focused. Um, and we're not looking for a global product. So there are some misalignments, I guess, in what we felt the philosophy and the process is lined up as.
And I'm just going to take the opportunity to just add to that. So I think what you're referring to there are asset managers that are trying to strengthen their case by pointing to offices and resources and all of that, and
Yeah,
actually that led to you not believing
yeah,
or not necessarily believing but having lower conviction, because ironically what on the face of it might seem better to have more offices, more people, in fact was actually a negative when it came
yeah,
to you digging in. So I just wanted to
yeah,
really, because I think that's a great point and one that asset managers should really consider when they're kind of trying to add faces onto
yeah,
the page. Actually, are they relevant and additive?
yeah. I mean, I always say to, because asset managers always ask me, oh, what would really help you? What can we give you? And I always say to asset managers, I said, it sounds really, really cheesy, but please just tell me the truth. Because the problem is if you start telling me we're using a team in Toronto where there are 3,000 million people to look at UK equities, and then actually I find out that that team in Toronto is not looking at UK equities at all. I was like, the whole thing falls down, and I
Yeah.
can't get the conviction. So I always do say, very much your point, say to them, just tell me who's actually working on it, because you can have very strong teams that are very, very small, and it works because the turnover numbers mean that they don't need that many new ideas every year, etc., etc. Um, but it doesn't stop, as you said, it doesn't stop asset managers trying to tell me that they've got teams all over the world working on products, which makes no sense. A couple of other things fell away because we had concerns with some of the business units. So the stability and prospects of this particular asset class within a business. So things like if there was a declining asset base, a continuing declining team, and we felt that there had been a decrease in the business significance of that asset class. It's just when you're trying to build up a new position in a new fund and a new firm, you really want to feel that there you have that stability.
Mhm.
And we look at things like that, like assets are an easy one to do, but also elevated team turnover, changes within the team, experience of the individuals that left versus the ones that are coming in. So it's quite thorough when we're looking at things like that. Um, we try to understand the investment universe. So all these products we're looking at, was there anything that was going to potentially negatively impact alpha in terms of what we wanted in the way that they were looking at the fund. which again isn't to say it's something we fundamentally don't believe in, but if it wasn't something that met our objectives at this time, we wanted to rule that out. Um, One of them actually got ruled out on because we had concerns around the limited operational setup. There's all different reasons.
Super useful. And sorry, just on that last one, so limited operational, as in like you didn't think that the firm had well enough resourced its kind of back
Yeah,
office function. So that was basically a no for ODD purposes,
yeah,
so operational due diligence purposes.
yeah,
Yeah.
yeah,
Yeah. Interesting. Okay. All right. So and thank you, because I know we're going really in depth, but at least I find it interesting. Hopefully the
yeah,
listeners will as well. So then we've whittled it down to the four for the reasons that you've just gone through, and then
yeah,
at that stage, you've presumably got the managers into the office, or you've organised meetings with them. Talk us through, the process from there on out. Presumably you selected one at the end. So what did that kind of process look like? You've already done a huge amount of research. You know a lot about these funds. Presumably you're going in and you've got a big long list of questions that
yeah,
you're asking them. Just give us a sense of that.
yeah. So well, it is exactly that. I'll tell you the interesting, well, I think it's interesting thing. So yeah, we whittled it all down. We go and meet these four managers, and I'm very happy I can talk you through the questions because we spent hours prepping our agendas, going to the meeting, writing up really long meeting notes. Before this point, I'm really keen on keeping everything not brief, as in like we've got to be clear, succinct. I don't want 50 pages on a manager we're not taking forward. Keep it like good to a good length. But then once we got to these last four, I was like, no, we need detail now. This is where like I want more detail in everything that we're doing. But you think all this work and we've done all this huge amounts of work, they're all going to be for very strong managers, which is quite often the outcome. And it's usually a very, very hard decision. And I will be completely honest, one of the managers, but even regardless of everything we did, stood out so much weaker than the other three. The other three were strong. They hit all the points we needed to. Two of them were then incredibly strong runners up. We always make that really clear actually when we're presenting to the board, because we never want to be in a position where we're forced, like if all of the managers had been like the rogue fourth manager here, that's not actually a good position to be in at all, because it means you're kind of forced to pick a manager, and the board certainly does not want that to be the situation. But it was really interesting. So despite all that work, it was only on meeting the manager and discussing with the team um, what they had done, well, were we able to actually realize that actually we didn't think that they were a strong candidate. The other three lived up to what we thought they would live up to, but to me, I found that really interesting. Like, despite all that work, still, in my view, there was one manager that got through that was quite weak. And I'm pretty sure your next question is going to be to me, why do I think they were weak? And
Yeah.
actually, it comes back to
Thank you. Save me
yeah, so
asking.
yeah, and actually, it comes back a bit to what I said earlier about the lying thing. So one thing was they did that classic thing of, we have a whole team and da da da. And I quite often will ask questions like, tell me about your top 10 stocks. Where did your ideas come from? Because I want to know how important the team is, how important the portfolio managers, like wherever these ideas come from, who's generating them. And it's good. It may be very good that it's from the team, especially if it's a strong team. That's a great alpha input. Anyway, despite talking to us for a long time about how useful the team were and how great they were, it turns out that not a single idea in the portfolio was driven by anyone on the team. It was all driven by the portfolio managers. It then also became very, very clear that they had made a change in process, which hadn't really been spelled out in the RFP. So there'd been a jump in the number of stocks that they held. And we'd spotted this when we had it in. We were like, okay, we'll find out about that. But actually it wasn't a jump because of the markets, or it was actually a jump because they totally changed the process and decided, because they had had good performance, that they were going to just take on more risk because they were good at what they were doing, which in theory sounds fine. But I'm like, but what if there's bad performance, which inevitably most of them, are you just going to change that again? Like, you can't let your process be led by your performance. So, yeah, that was disappointing.
Interesting. Yeah, that's definitely a red flag, isn't it? Kind of change. I think you put it perfectly. Yeah, performance shouldn't drive process. Process should exist because it's, you're learning from your mistakes, and that doesn't sound like that's what was happening. So in some respects, it made it easier because you then had
Yes, yes,
three to choose from. So
yeah.
how did you go about selecting one when there were three incredibly strong
So they
candidates?
were really strong, and I'll be at this point. It was just about looking for weaknesses because I they were all strong candidates, and it was just looking for weaknesses to understand where we felt the strongest one was, and on one of them and it's not to say that this was something that we thought was a showstopper. It was just it was the reason why we said no.
You had to choose one basically, so
Yeah,
you were kind of, yeah.
yeah. So one of them it was they had some product proliferation going on into areas they hadn't done before. So just some concerns about how that would be managed.
Within
Especially
the team that you were investing in, or within the wider firm?
within the team and
Right.
and the wider firm. It's a bit complicated, but it's not to say they may well be incredibly successful with that, but it's an unknown, and that's as I said, we need to have conviction in things being repeatable and understood. So at this point, we decided that actually we wouldn't take that manager forward.
Hmm.
And then the other one was, again, it wasn't a reason on itself that we would necessarily have rejected, but it was in this case, and it was just we just felt there was too much high key person risk given the complexity of the process.
Yeah, which
So
is a valid,
yeah,
definitely a valid reason, especially
yeah,
with your long-term perspective in mind. And I guess with a lot of manager moves having happened recently, it probably makes you more alive to
yeah,
key person risk, I would
yeah.
imagine.
Yeah, I mean, I find key person risk quite an interesting one because if the process is simple and don't know how to phrase this without sounding flippant, but isn't too unique and specialized, then in some ways you can that key person risk is diminished. I'm trying to think who was the originator of the growth portfolios at Berenberg? I can't think of his name. And I think he moved to Wellington and then but actually he was able to establish a great franchise. Berenberg continued their great franchise. And then I think his number two then left and well, I don't think I know left and went to not Berenberg. It started at Allianz. He went to Wellington, and then the number two went to Berenberg. But anyway, my point is they've all got great European growth franchises on very similar processes. They've still got, unique quirks and differences in them, but it's a really solid process that was set up. And at which point is it the individual or is it the process that's successful, or is it obviously a bit of both? But it has been replicated. Um, I guess you can look at that as well with Alliance Bernstein and things like Pacina and Arga, like almost a family tree of value investing
Mhm.
globally. And again, it's like it's got such a robust process that actually they were all able to set up very successful franchises on effectively a very similar philosophy and process. But if the philosophy is a bit more complex and a bit more nuanced and the process involves a bit more than that, then I think the key person risk can become more important. But it's a very fine line, and being able
Yeah.
to say when it isn't important is very difficult. And ultimately, if you have a person who is excellent, saying, oh, I'm not going to invest in this excellent, amazing person because they offer key man risk and they stay in that position for 20 years would be a bit of a fool's game. So I think I'm always nervous when people talk about key man risk because I think you need to be aware of it, you need to understand it, but I think you need to understand it in the context of the whole product. And sometimes, I mean, investing is risk, right? But sometimes you need some key man risk because actually it is very difficult. You need a very skilled portfolio manager to run it. And if they're not a key man risk, then why have you invested with them?
Yeah, I think that's a good way of putting it. Certainly, I was happy to invest in managers who, you know, were sort of star managers, if you like,
Yeah,
you know, or might be considered as that now. But as you say, it depends on the strategy, doesn't it? And I like
yeah,
your kind of, you know, it's obviously difficult um, to really, as you say, kind of draw that line. But the sort of simple versus complex, I
yeah,
can see that why that might have played a part. But I also know that you had three very strong candidates, and so really it was kind of in the nuance of
yeah.
you know, and presumably when you said no to those managers, you said no with them, you know, being very aware that it was a very close call, and
Yeah,
you
I
know,
mean,
and
yeah,
obviously they'll take something from that.
yeah. I mean, I always try very, very hard to give honest and timely feedback because I think a bit of what we said earlier, it's a privilege that these people spend time with you. They fill in these RFPs. It takes hours. I mean, I know it's not always a portfolio manager filling in an RFP, and the bigger houses have RFP teams, etc. But it is a huge undertaking. And I do know that some manager researchers don't like to give feedback. But I feel very strongly that why wouldn't you? There's some things obviously that you won't say, but I do always try and make the time to make sure that I have fed back and that I am as honest as I can be.
I think that is a, you know, well, that's something that any asset management teams or sales teams listening will be very grateful for, because it makes an enormous difference to them. But also, you know, the fund researchers listening, I think if you can be honest, that's the only thing actually that the asset managers need, is just honesty. Because, you know, enough people saying, actually don't reference your Toronto team who aren't really looking at UK equities or whatever it might be, you know, actually might get them to change that and
Yeah,
realize that, you know, you've got to just be honest about what it is. And
yeah,
so yeah, I think it's great that you do that, that you take the time for that, because I know you're
yeah,
incredibly busy, but it's important. I think, you know,
yeah,
you're being given time by asset managers, potentially by other teams, as you mentioned, in relation to, you know, RFP teams, etc. So yeah, to give that kind of final feedback, I think is
yeah,
super important, even if it's a no, right? That's
yeah,
almost more valuable, even though a yes would
exactly.
be
Yeah,
nicer, a no is
yeah.
probably more valuable.
And I do always caveat it with them, a bit to your point earlier, because I say just because I'm saying this doesn't mean the next time I meet you, you need to tell me that everything's changed. A bit back to the honesty thing, because I have had experiences where I've gone in and, given some feedback. This is more actually in my institutional day. So I would say, oh, I'm a bit concerned about resourcing, for example, and they'd say, okay. And anyway, the next time I come in, they tell me they've got all these resources and this is happening. So then I'm like, oh yeah, but I'm a bit concerned now about how much time the portfolio manager is spending training up all these juniors versus running the money, which is actually a bigger concern than my initial concern about the resourcing. So I'm always like, be careful, because a lot of these things are double edged, right? Like
Mm.
there's no perfect fund manager, right? So I always say to people, like, this is my feedback, but it doesn't mean you should go and tick all the boxes that I've got here, because you're asking me for feedback, so you're only really generally they only want to hear things. It sounds a bit weird that it's negative, really. They don't. I can tell them the good stuff, but what they're really scribbling down is anything I say negative. I'm like, but if you fix all these negatives, be careful, because there might be a much longer list of positives that you're unintentionally damaging by trying to fix these handful of
Mm.
negatives that I've mentioned. So I always
Mm.
do say when I give feedback, I'm like, I'm happy to give you this feedback, but don't take this as like the absolute gospel of like what everybody wants or what you should do, because there could be unintended consequences to the entire process.
Extremely good advice there. And I think that, you know, the reality is it just comes back to the honesty point, right? Like,
Yes.
don't
Yeah.
don't try and represent it as this or that. Just tell the truth. And,
Yeah.
you know, some people it won't resonate with, and that's okay. You know,
Yeah.
you're not gonna get 100% of the
Yeah.
opportunities, but you just need to find your people that, you know, that it does
Yeah.
resonate with. And yeah,
Yeah.
and you won't actually find them if you've represented it as something else. So
Yeah.
yeah, massively good advice. Fantastic. Listen, we've spent basically an entire episode talking about an extended kind of idea generation, which I've found hugely useful. Is there anything that we're in a minute we'll come to the 3 questions that we always finish the podcast with. Are there anything else that you want to say to the listeners about, fund selection, things that you think are important that we haven't covered? Just want to give you the opportunity to do so.
I think when it comes to fund selection, I genuinely think there is no one way that's going to make it work every single time, and just nothing avoids the hard work. We did mini RFP on the search I'm talking about. We don't do that every time. We needed to on this one, and ultimately, I think you need to approach each one uniquely, and there's no one size fits all in this, in my opinion.
Yeah, completely agree. Okay, so we've got to the end of the podcast, Hannah. This has been absolutely fascinating, and I, really appreciate your kind of depth of responses and analysis. I think it's really, really impressive. What I'd like to do is come to the kind of last part that we always do on the podcast, which is to ask you some finishing questions. And the first one is, what is a book that has had the biggest impact on how you think?
So it's not exactly a book, but it's a film, I think, which I watched. Since is not at all a standard answer, I don't think, but it's what has come to mind. With the children, I think it might have been a book, Moneyball, and it's actually about baseball. So this is completely
It's an
unrelated.
amazing film. No, it's not unrelated. It's got loads of connotations with finance, right? Yeah. Tell us about it.
I think it's because I watched it this week with them, just chilling out, and it's I guess the main thing is it's about using data-driven analysis and doing the work yourself to get to the conclusion, not always following the herd, like making sure you know what you're doing, being reassured that you've done the work and that it's going to come to a good outcome. It just resonated when I was watching it. I was actually thinking about it. Obviously, I didn't have that discussion with the children because they would have thought I was insane. But yeah, the film worked. And if anyone has seen it, you might get it.
Yeah, I've actually watched it multiple times. I think it's a brilliant film, and that I really do believe that there are, it's obviously data in baseball, but it's completely, the idea that you can, and kind of to the point you made, actually, you talked about your MPS. It's kind of like your MPS is the baseball team, and your funds are kind of like the players, so, or even your managers are the players. So yeah. Cool. So that's question 1. Question 2 comes from our previous guest, which was Ryan Hughes. So he asked, what event or events early in your career shaped who you are as an investor today?
Yeah. So it's not an event, it's a manager, I think. And he was an excellent manager researcher. Excellent. He was a very hard manager, but it has made me so much stronger at being a manager researcher, and also being able to deal with difficult situations, uncomfortable situations, which we haven't touched on this podcast at all. And we spoke about it is an absolute privilege. And most of the time it is. But also sometimes as a manager researcher, you might find yourself in some awkward situations. And he gave me the insight on how to deal with people who can be excellent but very difficult, and it's definitely shaped me.
Nice. When you initially said manager, I assumed you meant fund manager, but you actually meant your
manager.
sort of line manager.
Yeah.
Okay, interesting. Yeah, I mean, managers can have well, almost arguably the biggest impact on our lives and our career, outside of our personal life than anything else. So yeah, interesting. Cool. And then now the table's turned for you to be able to ask a question for our next guest, and you don't know who that is yet, but what question would you like to pose for the next guest on the Fund Selectors podcast?
What's your biggest bugbear about when you're undertaking, be it manager research, because obviously I don't know what the next person in my position will be, or what you do within the industry? What's your biggest bugbear of the industry?
Biggest bugbear within, so mostly are going to have some impact on the manager research process. So should we say the biggest bugbear in manager research?
Yes, provided that person, I mean, obviously, depending on who you've
Yeah,
got next
assuming
in,
that makes
if they don't
sense.
do manager research, then it might
Then
need to
I'll
be
skew
shifted
the
a bit.
question.
Yeah,
Yeah, no,
exactly. But
thank you
yes,
for your
yeah,
flexibility with your question.
yeah.
That's very generous. Fantastic. Well, listen, Hannah, this has been an absolute pleasure. You have, yeah, just been really successful in your career, both through institutional and then leading the manager research efforts at Omnis. And yeah, really glad to have had you on and for you to share your insights with the audience. And thanks so much for your time.
Great, thank you. Take care, Lucy.